Welcome back to the ProTicker podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
It is good to be here.
Yeah.
And looking at the sheer volume of red tape and red numbers on the desk this morning, I think we picked the perfect day to dig in.
I'll say, it feels like one of those mornings where the market is just holding its breath. You know, that specific kind of silence.
I do.
It's not just one headline. It's this cocktail of macroeconomic anxiety. Is the economy finally stalling out, mixed with some really specific high-stakes corporate drama?
It's a day defined by expectations versus reality. We're waiting on jobs numbers that feel like a coin flip for the recession narrative. We're dissecting earnings that are moving stocks by, what, 20 or 30% in a single session.
Right.
And we are watching a massive and, frankly, brutal shift in the AI narrative.
Okay, so we're going to unpack all of that. We've combed through a heavy stack of reporting today from Bloomberg, CNBC, and Yahoo Finance.
Yep.
And our mission for this deep dive is to connect the dots. We need to figure out the relationship between a U.S. consumer who has suddenly stopped spending, a Super Bowl-level jobs report, and this pivot on Wall Street regarding artificial intelligence.
It's a pivot from who is building AI to, well, who is about to get crushed by it. And that distinction is causing some serious portfolio damage today.
Which is a terrifying thought for anyone holding legacy stocks. But before we get to the robots coming for our dividends, let's talk about the humans. Specifically, the humans who stop shopping. We have to start with the retail data because this looks like the smoking gun for the recession bears.
It really does. The headline from Bloomberg and CNBC regarding U.S. retail sales is remarkably unexciting, which is exactly why it's dangerous.
Right.
December consumer spending was flat.
Flat. Zero growth.
Zero.
And context is king here. December is supposed to be the holy grail of retail. Expectations were for a 0.4% gain, right?
Correct. We missed the mark completely. And think about what flat means in an inflationary environment.
Right.
If prices are up, but the total amount spent is flat, it means people actually bought fewer things. The volume of goods moving through the economy is shrinking.
That's a critical distinction. It's not just that people spent the same amount, they got less for it, or they just stayed home. And the ripple effect was immediate in the currency markets.
Oh, absolutely.
I saw the dollar took a nosedive, specifically against the yen. Walk us through that mechanism. Why does a bad shopping month in Ohio hurt the dollar against the yen?
It's the market doing the math on interest rates. When the economy looks weak, like flat retail sales, weak investors immediately bet that the Federal Reserve is going to have to swoop in and cut interest rates to stimulate growth.
And lower rates mean a weaker currency?
Usually, yes.
Yeah.
Bloomberg is reporting that swap markets, basically where the big banks bet on future rates, are now pricing in over 2 quarter-point rate cuts this year.
So bad news for the economy is treated as sell news for the dollar because the yield is going to drop.
Exactly. And the yen strengthened because Japan isn't cutting rates. So the gap between U.S. rates and Japanese rates is shrinking, which pushes the dollar down.
It's a classic interest rate differential play.
But it's happening fast.
But it's not just us, is it? I saw CNBC reporting on Asia markets. They were mostly up. But the data coming out of China seemed to contradict the optimism.
It's the deflation story rearing its head again. China's inflation data came in at a 0.2% rise, missing the 0.4% forecast.
So incredibly weak demand.
You got it. When prices aren't rising, it means people aren't buying. So you have the world's two biggest economic engines, the U.S. and China, both sputtering at the same time.
Which brings us to the main event. If the consumer is shaky, the only thing keeping the floor from falling out is the labor market.
Right.
If people have jobs, they'll eventually spend. But if the labor market cracks...
Then the recession isn't a forecast anymore. It's a reality. That's the fear.
And today isn't just any jobs report day. Yahoo Finance is calling this the Super Bowl of jobs reports.
A bit dramatic, perhaps, but accurate in terms of stakes. Remember, this January employment update from the Bureau of Labor Statistics was postponed due to that partial government shutdown.
Right, so we've been flying blind.
For weeks.
So the anticipation has just been compounding. It's like waiting for a game that got rain delayed 3 times. Everyone is edgy.
Precisely. Now, the official consensus among economists is a gain of roughly 68,000 jobs, with unemployment holding steady at 4.4%.
68,000? That doesn't sound like a boom time number. That feels, I don't know, barely replacement level.
It is modest. It's what we call a soft landing number.
Yeah.
Not too hot, not too cold. But here's where it gets interesting.
Okay.
There's a whisper number floating around that suggests it could be much worse.
Define whisper number for us briefly, because that always sounds like insider trading, but it's really just market sentiment, isn't it?
Sure. The consensus is the official average of all the bank economists that gets published. The whisper number is what the traders are actually saying to each other on the floor or, in private chats.
It's the rumor mill.
The rumor mill. And Yahoo Finance picked up a quote from Peter Navarro, Trump's trade counselor, speaking on Fox News. He warned that expectations should be revised down significantly.
Down significantly from 68,000 puts us dangerously close to zero or even negative territory.
And you can see that fear in the futures market right now. Dow, S&P, NASDAQ, they're all slipping or flat. Wall Street is bracing for impact.
So if we get a big miss on jobs,
Combined with that flat retail data we just discussed,
the
the recession alarms are going to ring loud and clear.
it feels like the market is looking for a reason to panic, and the data is starting to provide one. But shifting gears, while the macroeconomy is struggling, there is a micro-war happening in the stock market that I find even more fascinating.
Oh, yeah?
I want to pivot to what Bloomberg calls Wall Street's new trade.
This is a critical evolution in market psychology. We need to really pay attention to this. For the last, 3 or 4 years, the AI trade was simple. By the builders.
The builders, so NVIDIA, the chip makers.
By NVIDIA, by the chip makers, by the cloud providers.
Right, the picks and shovels strategy. If there's a gold rush, sell shovels. That's investing 101.
Exactly. But now, Bloomberg says the trade is shifting. Investors are dumping the stocks that are in AI's crosshairs
So they're hunting for companies that might be replaced by AI.
and selling them aggressively.
The phrase that stuck out to me in the report was sell first, ask questions later. It sounds panic-driven,
It is.
and they have a specific example that is just brutal. Walk us through the situation with Altruist and the wealth management sector.
This is a classic disruption story, but moving at warp speed. So you have a startup called Altruist. They released a tax strategy tool called Hazel.
Hazel! Sounds friendly. Like a nice grandmother who knits you a sweater and gives you hard candies.
Well, Hazel is not knitting sweaters. She's shredding business models. This tool uses AI to execute complex tax strategizing for clients. Normally, that is high-touch, expensive human work.
Right.
The moment Hazel dropped, shares of giants like Charles Schwab, Raymond James, and LPL Financial tanked. We're talking drops of 7% or more in a single session.
Just because of one startup's beta launch. That seems like an overreaction, doesn't it? These big firms have moats, they have relationships, they have trillions in assets.
You would think so. But Bloomberg quoted Jason Wink, the CEO of Altruist, and he said this AI architecture can replace entire teams of people for $100 a month.
$100 a month. That is the cost of a nice dinner, and it replaces a team of CPAs.
That is the number that scares Wall Street. It's the margin compression. Even if Schwab and Raymond James survive, can they charge high fees for tax advice when a bot does it for a subscription fee?
That is the displacement risk.
Yes. If your primary value proposition is human expertise in a standardized field tax, basic law, insurance adjustment, Wall Street is looking at your stock price and asking, why is this worth 20 times earnings?
It's the commoditization of white-collar work. We've seen blue-collar automation for decades, but now the algorithms are coming for the corner offices. And looking at the stack, it's not just finance, is it?
No. Look at Dassault Systems, the French software giant. Their stock plunged 22%.
Wow.
That is their worst day on record.
22% is a crash, not a correction.
Yes. And while they had some earnings issues, the narrative driving the sell-off is that AI is starting to write code and design software better and faster than legacy software companies.
So the market is pricing in obsolescence.
It is. Investors are looking at software firms and asking, can ChatGPT write your product for free?
It feels like we moved from AI is a cool tool to help you work to AI is the worker really, really fast.
That is the shift. We're moving from augmentation AI helps you to replacement AI is you.
Yeah.
And that brings massive volatility to sectors we thought were safe, like professional services.
It essentially turns boring stocks into high-risk assets overnight.
Absolutely.
Well, speaking of AI as the worker, that leads us right into the dark side of this boom, because if we're handing over the keys to these AI agents to do our taxes and write our code, are they safe?
That's the question.
We have a report here from Yahoo Finance citing a Microsoft CyberPulse study, and honestly, the numbers are alarming.
They are deeply concerning. The report found that 80% of Fortune 500 companies are now using AI agents.
Which makes sense, given the productivity gains and cost savings we just talked about. If you can replace a team for $100, you do it.
Right, but here's the kicker. Only 47% of those companies have security controls in place.
So half of the biggest companies in the world are running these powerful, autonomous AI tools with basically no seatbelts.
Worse, 29% of employees are using what's called unsanctioned agents,
Shadow AI.
shadow AI.
That's me using a random chatbot to summarize a confidential meeting and not telling my IT department because I don't want to wait for approval.
Exactly. And that opens the door to a specific threat the report highlights called recommendation poisoning.
This sounded like something out of a cyberpunk novel. How does this actually work in practice?
So imagine you are a business owner. You use an AI agent to find a contractor to fix your HVAC system. You trust the AI to scan the web, read reviews, check prices, and give you the best option.
Right. Hey, computer, find me the best AC repair in town.
But a bad actor knows you're going to do that.
Yeah.
So they manipulate the data the AI reads, maybe by embedding hidden instructions in a document or a website that the AI scrapes. They poison the memory, so the AI ignores all the other companies and only recommends the one the hacker wants you to use.
That is insidious. It's not hacking the computer to steal data. It's hacking the advice the computer gives you.
Precisely. It breaks the chain of trust. If you can't trust that the AI is being objective, the utility collapses. You're essentially hiring a corrupt employee.
So what's the fix? Did Microsoft offer a solution, or are we just doomed to bad HVAC recommendations?
They suggest a zero-trust policy. Basically, you have to stop treating AI agents like software and start treating them like employees.
Meaning what? They need an ID badge?
Essentially, yes. They need identity verification, passwords, biometrics access controls. You don't let a human intern wander into the server room without a badge. You shouldn't let an AI agent scan your entire database without verification either.
It's about limiting privilege.
Exactly. We have to stop thinking of them as tools and start thinking of them as entities.
It's wild to think we're at the point of card-swiping robots. But speaking of chaos in the AI world, we can't ignore the drama at xAI.
No, this is a major story from CNBC. Elon Musk's AI company is going through some serious turmoil right now.
Turmoil seems mild. They lost 2 co-founders in 2 days.
Jimmy Ban and Tony Wu. And this follows other high-profile departures recently, like Igor Babushkin. It's a significant brain drain at a very critical moment.
Right, because xAI just merged with SpaceX, didn't it?
It did, creating a behemoth valued at $1.25 trillion. But here is the reality of AI. The value isn't in the factories or the servers as much as it is in the brains of about 500 people worldwide who really understand this tech.
Money doesn't write code.
People do. And when the key researchers walk out the door, investors get very nervous about model decay.
And it's not just the exits. They're facing regulatory heat, too.
Correct. Probes in Europe and Asia regarding their Grok model, specifically the generation of deepfake images. It's the classic move fast and break things mentality colliding with global regulators who are saying, stop breaking things.
It adds a layer of risk.
A huge layer of risk to what is supposed to be the most valuable company in the world.
So let's recap the vibe. We've got macro fear with the consumer, AI disruption, crushing legacy stocks, security holes in the Fortune 500, and executive turnover at the biggest AI unicorn. Let's see who actually made money. It's time for the earnings scorecard.
The volatility here is breathtaking. Let's start with the losers column because the drops were steep.
Start with Lyft.
Down about 17% or 18%. The issue here was a surprise operating loss projected for 2025. The market thought the turnaround was further along, and this guidance shattered that confidence.
So profitability later isn't selling.
Not in this high-rate environment, no.
And then there's Mattel. I grew up on Hot Wheels, but apparently they aren't flying off the shelves.
A 28% crash.
Ouch. That is painful.
It was a huge miss on guidance. It just reinforces that consumer softness we talked about in the intro. Parents are pulling back on discretionary toy spending.
When money is tight, you buy groceries, not Barbies.
It's a direct read on the American family's budget.
What about Robinhood? They beat earnings, didn't they?
They beat on earnings per share, yes, but they missed on revenue. $1.28 billion versus $1.34 billion expected. And notably, crypto revenue was weak.
And the stock dropped 7%.
It did. It shows that investors want growth, not just cost-cutting.
And Moderna.
Down 8%. The FDA refused to review their flu vaccine application. They said the data comparisons weren't sufficient. That's a major regulatory setback for their pipeline.
Proving again that biotech is a gamble on government approval.
Always is.
Okay, give us some hope. Who won today?
Cloudflare.
Ah, the infrastructure play.
Exactly, up 15%. Why? Because while everyone is selling the wealth management firms that AI might replace, They are buying the companies that make the AI work.
They provide the security and speed for the internet.
Right. Their outlook is strong because of the AI build-out demand.
So they are selling the shovels.
Precisely. And Teradata is up 16%. Upbeat forecasts. Again, data analytics. If you are in the business of handling the data that feeds the AI, you are winning.
And if you're in the business of doing the job the AI learned to do, you are in trouble.
That is such a clear dividing line.
Yeah.
Before we wrap up, I saw a note on crypto in the Yahoo Finance stack. You mentioned Robinhood was weak on crypto revenue, but what's Bitcoin actually doing?
It's shaky, but the whales are buying. Wallets with more than 1,000 Bitcoin bought up $4 billion worth of tokens recently.
$4 billion. That's a lot of conviction.
It is. They're trying to put a floor under the price slide, but the retail enthusiasm just isn't there right now. It suggests the smart money is accumulating while the average investor is scared off.
A familiar story in that market. So, looking at this whole picture, from the retail flatline to the AI kill zone in the stock market, what does this all mean for the person listening right now? I think we are seeing a market defined by duality. On one hand, you have the physical economy, people buying toys, taking lifts, shopping for clothes.
Yep.
That is flashing warning signs.
Right.
That puts all eyes on the jobs report. We need to know if the consumer is bending or breaking.
And on the other hand,
you have the AI economy, which is ruthlessly sorting winners and losers.
Yep.
It's boosting infrastructure stocks like Cloudflare, while simultaneously destroying the valuation of service stocks like wealth management.
it's no longer a rising tide lifting all boats.
No, it's a tsunami that lifts some and capsizes others. You have to know which boat you're in.
That is a vivid image to leave us with. I want to go back to that zero trust concept for a second. If companies need to start treating AI agents like employees, giving them ID badges, verifying their access, monitoring their work,
Right.
how long until those agents start demanding a paycheck? Or at least how long until the companies running them start charging salary-level subscription fees?
That is the trillion-dollar question. If they do the work of a human, they will eventually be priced like one.
Something to think about as you head into your Wednesday. Thank you for listening, and remember,
We'll see you all tomorrow morning with new headlines from major financial magazines.